Ever wondered how different depreciation methods work? Well, allow me to enlighten you. When we talk about depreciation, we're referring to the reduction in value of an asset over time. It's a bit like aging, but for objects instead of people. Depreciation is a fundamental concept in accounting because it helps businesses make sense of how their assets are performing. Imagine you're a business owner with a fleet of delivery trucks. Those trucks aren't going to last forever, right? They'll wear out, break down, and ultimately they'll need to be replaced. That's depreciation in action. There are several ways to calculate depreciation, each with its own unique flavor. Some methods spread the cost evenly over the asset's life, while others front-load the expense. Some even tie the cost directly to how much the asset is used. In this video, we'll dive into 3 popular depreciation methods and how they work. So buckle up. It's going to be an enlightening ride. First off, we have the straight-line depreciation method. This is the most straightforward and commonly used method of calculating depreciation for an asset. It's called straight line because the amount of depreciation remains the same throughout the asset's useful life. Imagine a straight line on a graph. The horizontal axis represents time, and the vertical axis represents the asset's value. As time progresses, the asset's value decreases uniformly down this straight line until it reaches 0 at the end of its useful life. That's the essence of the straight-line depreciation method. Now, let's break it down. The straight-line depreciation method calculates the depreciation expense by subtracting the asset's salvage value from its initial cost. The result is then divided by the useful life of the asset. The salvage value is the estimated value that an asset will have at the end of its useful life. It's important to note that this is just an estimate, as the actual market value of the asset at the end of its useful life can vary. To illustrate, suppose you purchase a delivery van for your business at $100,000. You estimate the van's useful life to be 10 years and its salvage value to be $10,000. Using the straight-line depreciation method, you would subtract the salvage value from the initial cost, leaving you with $90,000. Then, you divide this value by the van's useful life of 10 years. The result? An annual depreciation expense of $9,000. So, every year for 10 years, you would record a depreciation expense of $9,000 for the van. In summary, the straight-line method is a simple, consistent way to depreciate an asset over its useful life. It's easy to understand and apply, making it a popular choice for many businesses. And while it may not perfectly reflect an asset's actual decrease in value over time, it does provide a reasonable and systematic approach to account for depreciation. So, that's the straight-line depreciation, simple and consistent. Next up, let's explore the declining balance depreciation method. This method is a bit like depreciating on an adrenaline rush. It's all about front-loading the depreciation expense. In other words, the declining balance method depreciates an asset more in the early years and less in the later years. But why would anyone want to do that? Well, there is a rationale to this seemingly odd strategy. Some assets, like vehicles or high-tech equipment, lose their value faster in the initial years. So the declining balance method mirrors this reality more accurately than other methods. Now let's break down how this method works. The declining balance method uses a depreciation rate that's a multiple of the straight-line method. This rate remains constant over the asset's useful life. But here's the twist. The depreciation expense decreases each year because it's calculated on the asset's book value at the start of each year, which of course declines over time. Let's illustrate this with an example. Consider a delivery van that costs $10,000 and has a useful life of 5 years. Let's say we're using double the straight line rate, so our annual depreciation rate is 40%. In the first year, we'll depreciate $4,000. That's 40% of $10,000. In the second year, we'll depreciate 40% of the remaining value, which is now $6,000. So our depreciation expense for the second year is $2,400. This pattern continues, with each year's depreciation expense being 40% of the remaining undepreciated amount. So you can see how the declining balance method accelerates the depreciation, making it heavier in the early years. This method can be particularly useful for businesses that want to maximize their depreciation expense in the short term, perhaps for tax purposes or to match the rapid obsolescence of certain assets. But remember, while it front-loads the depreciation expense, the total amount depreciated over the asset's life will remain the same. The declining balance method accelerates the depreciation, making it heavier in the early years. Now we'll look at the units of production depreciation method. Units of production depreciation is a unique approach to asset depreciation, as it directly ties the depreciation of an asset to its actual usage or production output. Unlike the straight line or declining balance methods we've previously discussed, this method doesn't focus on the passage of time, but on the asset's productivity. Let's make it more tangible with an example. Suppose a company purchases a machine for $100,000. The machine is expected to produce 200,000 units over its useful life. After the machine's useful life, it's estimated to have a salvage value of $10,000. The first step in the units of production depreciation method is calculating the depreciation cost per unit. Here's how we do it. We subtract the salvage value from the cost of the machine. That gives us the total depreciable cost, which is $90,000 in this case. We then divide this depreciable cost by the total units the machine is expected to produce in its lifetime. So, $90,000 divided by 200,000 units gives us a depreciation cost of 45 cents per unit. Now let's say in the first year, the machine produces 25,000 units. We then multiply the units produced in the first year by the depreciation cost per unit, which gives us the depreciation expense for the first year. In this case, 25,000 units times 45 cents equals to $11,250. This method is particularly useful for assets whose wear and tear are more closely related to usage than to time, such as vehicles, machinery, or equipment. The beauty of the units of production depreciation method is that it accurately reflects the usage of the asset in the depreciation expense. If the asset is used more, it depreciates more, and if it's used less, it depreciates less. The units of production method makes depreciation directly proportional to the use of an asset. Now that we've covered the three methods, how do they compare? Let's put these three depreciation methods side by side to understand their unique characteristics and applications better. The straight line, declining balance, and units of production methods each have their own set of advantages and disadvantages, and the choice between them often boils down to the specifics of the asset in question and the company's financial strategy. Starting with straight-line depreciation. This method is the most straightforward, pun intended. It's easy to calculate, and it provides a consistent expense amount each year, which can make budgeting simpler. However, it may not accurately reflect the asset's usage or value over time. This method is ideal for assets that provide a steady value over their useful life, like office furniture. Then we have the declining balance method. This approach is a bit more complex, but it accounts for the fact that many assets lose more value early in their life cycle. That's why this method is often used for assets like vehicles or high-tech equipment, which tend to depreciate more rapidly in their initial years. But keep in mind, this method may result in larger depreciation expenses early on, which could impact a company's financial statements. Lastly, we come to the units of production method. This method is unique as it ties depreciation directly to the actual usage or production of the asset. It's perfect for assets where the wear and tear is directly related to how much they're used, like manufacturing machinery. However, it does require accurate usage or production data, which can be a challenge to track in some cases. Each method has its own strengths and weaknesses, and there's no one-size-fits-all answer here. It's crucial to consider factors like the nature of the asset, its expected usage pattern, and how the depreciation expense will impact your financial reporting. In the end, remember, choosing the right method depends on the nature of the asset and the company's financial strategy. So, there you have it, 3 depreciation methods explained. We've navigated through the simplicity of straight-line depreciation, where the asset's cost is divided evenly over its useful life. We've tackled the declining balance method, a more accelerated approach that subtracts more value in the early years of an asset's life. And we've journeyed through the units of production method, which bases depreciation on the actual usage or output of an asset. Each of these methods has its advantages and applications, and it's not about one being superior to the others. It's about understanding their unique characteristics and knowing when to apply them. It's about being able to determine which method best suits your company's financial situation and goals. Remember, understanding these methods not only helps in accounting, but also in making informed financial decisions. Because at the end of the day, it's not just about numbers. It's about making those numbers work for you.